Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Friday, June 12th, 2020. This one won't be as long as last night's. We'll keep it relatively brief. Hit on some of the things that I included in the post that went out about 5 minutes before the close today. I just wanted to get my thoughts out on that, and that was really somewhat of a follow-up to yesterday, showing you that as bearish as some of the developments were yesterday, and in the last few days, actually, last couple days in the major indexes, such as the small caps following through on the breakdown that happened the day before. Remember, large caps broke down yesterday. But in addition to that, we had some of the, actually all of the market-leading stocks still above support, and that's something to note. The market's not going to break until the leaders. I'm talking about the big FANGs: Facebook, Amazon, Apple, Microsoft. So they didn't break down today, and there's quite a few support levels. So that's what I wanted to talk on today. I want to show you some developments on the futures, just some things that gave me pause, for the very near term. What way I'd summarize it is we have some cross currents. We have some powerful sell signals that triggered, but then we also have some key support levels that the market's still above. And then most importantly, keep in mind that we're coming off a very resilient and strong uptrend. Usually, now this isn't the usual market, I'm going to say that, but usually you don't go from this to this. Usually there's signs. In other words, tops are a process, not an event normally. But again, this isn't a normal market, so we'll be open to anything. And as I said, don't do what I do. Do what you do based on what you see and what you believe in the charts. I went home. I did go home mildly short, despite some. I'm going to show you some things that could cause a rally next week, and if they don't, then that's going to be bearish. I'm going to point out some divergences and some key support levels that so far have held. All right, starting out here with SPY. So again, we're going to kind of go over the good, the bad, and the ugly. For the bearish case, we had number one, we had a failure at the gap right there. That was that big old gap right there that started this whole thing off, and SPY went up, tested it at the bottom, failed, then went on to break down, put in the island cluster top right there, leaving those 4 candles separated by big old gaps on each side, followed by a big red candle. Like I said, scale 1 to 10, it's a 10 for a sell signal. However, it doesn't guarantee. There's absolutely no guarantees in trading and investment. So what you have to look at, that's looking at things glass half empty, let's say, through the bearish case. And through the bullish case, then it's a greatly needed pullback. We had overbought conditions after a very strong run. Even the most ardent bull will agree that you need to have corrections along the way when prices get ahead of themselves to continue a healthy trend. So just pointing out what I see in the charts, and then of course you have a pretty big support here, about 300. Not actually, I take that back. It's not a very on my SPY chart. It's not very well defined, and that's why I do these videos. There is a line, and I've had that line there before. I know this is a busy looking chart, but you have price support around 300, which held today. A little brief dip below, and that was a whipsaw. We snapped back above it. I told you earlier, if we took out today's earlier lows, yesterday's lows, we'd probably continue down, and that proved to be a whipsaw. And we're also above, as I mentioned, right on. Let me turn all these lines off here, and you can see, as I pointed out yesterday, we hit and held on the 200-day simple moving average. Today we took it out intra-period, but we closed the day comfortably back above it. So again, like I said, if you want to give check marks, that one goes to the bulls. Successful test and defense so far, 2 days of the 200-day simple moving average. And if that happens to go, you have the 200-day exponential just below, and what I believe to be a more significant support level on SPY. You have the top of this multi-month trading range right there. That should have been a box tool. Would have given you a flat line up top, right around there, give or take, somewhere around there. So plenty of support on the way down, and those are the cross currents. So sell signals, yes. A little more work to be done to really open the door to a much deeper sell-off. Do I think it'll happen? I still put good odds on it. And again, that's part of a, if this is a bear market rally, it needs to look convincing to the masses at top. You need to have, and you almost have to expect the dip buyers to come in here and buy. And now if they if and as we start to see these support levels go, especially where I think really it'll be you'll get that impulsive selling is if and when we take out the bottom of that multi-month, that almost 2-month trading range there from early April to late May. We broke out. Yeah, we broke out about right here. I had the top of it right there before, give or take. It was flirting with a 200-day. So that's really a big level, and there's a lot of support on the way down below. So let's just take it as it comes. We'll see how it happens. I mean, if next week we just do this, then man, that's really bearish. But if we stair step down, which is kind of the way I'm leaning towards, I'll tell you, whether we bounce tomorrow on Monday or not, I think we stair step down, work our way down, and then the selling begins to accelerate if and when we get there. But first things first, we can do this if the buyers step in here, defend the 200-day moving averages, price support, especially if they can get back up in and backfill that gap and then some and take out that island cluster top. That would be pretty darn bullish and most likely open the door for a move to new highs. So we'll just assess the charts if and when that happens. But that's not, as of now, it's not the way I'm leaning. But again, we don't always get what we want, so we'll watch the charts. As I like to say, the charts are dynamic, and so is my analysis. A QQQ, we had the minor trend line. The yellow one broke, solid sell signal, but we hit this blue trend line. That's where yesterday I mentioned, for active traders, reverse, go long. Game of bounce, we hit it again. We took it out intraday, but then closed back above it. So I can, I have to give a check mark to the bulls on that one, especially because they managed to regain it after we broke down. So that gives you a little bear trap type scenario in there. So bulls get a little check mark there. And at the end of the day, I always say this: when you're trading a daily chart, or if you're trading a 5-minute chart or a weekly chart, the most important thing is how the candlesticks on that time frame close. So by waiting for, I would say, a solid daily close below a level, that's going to increase your odds that breakdown sticks. Because intraday, this is how I always draw my trend lines. I don't know if I have any examples here. There's a little one there, but I draw my trend lines to the points that include the most numbers or the most candlestick wicks. The shadows, the part down below. If it's down below, it's called a tail. Up above, it's called a shadow. I'm sorry, up above, it's called a wick. So this is a wick right here on a candle. Down below, it's a tail, but they're both called shadows. So let's just call it a shadow. So I look for the most number of shadows and or bodies that hit that candle, as you can see there. And that's why this, to me, is very much just it helps validate this trend line. We managed to, take it out intraday, but close back above it. So that is, again, why I reduced, some of the short exposure that I had initially intended to go home. I recycled back in, as I told you guys, came in long to the day, and then, added back, close those longs, added back shorts. But, like I said, unless these levels get taken out, but there it is. Bulls can step in and buy here, or could have, and, maybe we'll see what happens next week. They're still important levels, and that trend line is still an important level. So if it goes with conviction, especially daily close, that will open the door to a move down to about that 228.68 level. Let me show you IWM, and then I want to look at the weekly charts and then go to the 60-minute charts, and we'll wrap the video up there. IWM, big, nice big wedge type pattern here. Solid, very solid impulsive breakdown. As I mentioned, the small caps broke down the day before the broad market. They broke down on Wednesday. Solid breakdown there, and then on Thursday, very bearish when they gap down and close well below that 145 level. It even goes to the left of the chart. Very, very good former support, and so that I'm still viewing this as a whipsaw signal, false breakout, and that is again, a pretty powerful sell signal on IWM. So I'll continue to reiterate what I think is going to happen. I think despite what happens in the very near term next week, I think we work lower. I think this has a good shot to be a major top there in the market. What would make that not be the case? Well, obviously, if we can get back in the gap here, let's turn off all the lines. Big old gap overhead, a full backfill of the gap. It wouldn't be ideal for the bearish case, but not too bad as long as we don't take out the top of the gap. Gaps are often backfilled, and that was what a backfill would look like, and we could reverse. But anything much more than that is going to open the door to take out these highs. It's going to also have, if it does happen, it will have regained this 145.08 or 145 level, we'll call it, give or take. Again, it's right around there. So those are the things I'm looking for on IWM. I'll watch for, and those are the things that can change, the technical outlook, or at least my outlook for the market. Everyone has a different outlook. Everyone's, reads the tea leaves different. We are still back below. Remember the 200-day exponential and the 200-day simple moving averages, the blue and the red line. We hammered or reversed right off the close on the 50-day moving average and held above it again today. So kind of pinching between some key moving averages. Put a higher weighting on the 200 days than I do the 50, but it's worth noting there. And you can see we traded through the 50 quite a bit there. So again, I put a higher weighting on the 200 days. One more thing to point out on the daily charts, other than I did point out recently we hit overbought readings for the first time since the last bull market, right before everything fell off a cliff. So that's certainly worth noting. And we do have, for the first time in a while, PPO bearish crossover. We had a little whipsaw here, but we have a PPO crossover, and you can see it a little bit easier when the lines are pinching when you put up a histogram. The histogram, PPO histogram, is a visual representation. If you don't have a PPO, some charting programs don't give you that. You can use a MACD. It's very similar, and then put up the MACD histogram. Sometimes a MACD histogram, you can make it, if you want, you can make it appear under the PPO or MACD lines. But what I'm looking for is the crossovers usually are followed, indicate a trend change quite often. We had a bearish PPO crossover right there, and that was a golden one. I look at it, told you, boom, trend change. And right here we had a bullish PPO crossover, and that it signaled a major trend change as well. So this was, and I did highlight these back at the time, as bearish, but it proved to be a whipsaw signal. We had a crossover, and then the lines cross back. But sometimes you get those whipsaw signals, and then you get the big one that sticks. So it's just worth noting we do have a bearish PPO crossover in addition to everything else. So that in itself is a check mark for the bears, as long as the PPO remains that way. And the deeper it goes, the more these lines cross like this, moving down. Well, the histogram is a visual representation of the differential between the two lines. In other words, when the PPO line is above the signal line, you got the big green bars, and the farther apart the lines are, the further apart or the higher the histogram, or lower the histogram bars. So that's what I'm trying to say there, is you get down here and then it's pretty clear it's no longer a whipsaw. And of course, the broad market is more important than IWM, the small caps, and there it is on SPY. So same thing, recent bearish PPO crossover, whipsaw there, but the real deal there, that one stuck. And even this one, the lines were flattened. I stay away from using the PPO crossovers, things like that, and divergences when you have hardly any separation between the line, at least PPO crossovers. But even back then, it looks like they were just little whippy signals, but you're seeing such a huge price swing there that what you have to do is almost move that off your chart. Let me do that for you. Let's take this, and down here I think it'll do it. Yeah, there we go. So see, now all of a sudden they don't look so flat, and you can then look at the signals here and see that they did a pretty decent job saying, look, trend has changed, bullish, you got a trend there, trend change to bearish. We went sideways, we didn't go down. Remember, this was a very resilient uptrend heading up to the highs. When volatility expands, then you start to get better signals on these crossovers. And there it is. So just want to mention there that when you go back or you include all the big price swings here, it really looks like those histogram, it makes those histogram bars flatten out, because it has to make room for these much bigger bars here. Expanded, price action and volatility was much higher in recent months. Okay, now that the week is over, we can see if we can glean any useful information off the weekly candles. Because again, if we're on Wednesday, Tuesday, Thursday, a lot can and often does change. But now that the week is over, we have this week's candle finalized. So let's zoom in a little bit here and take a look, see what it tells us. It's certainly a big bearish candle. That's a big red candle. It didn't quite engulf. To have a bearish engulfing, you'd have to engulf the body of this candle. The fat part would have to engulf the body of the previous one, and it just just missed doing that close. But what does stand out to me is, let's turn off all the trend lines and everything else, is the size of this candle. Let's measure it here. Big red candle. Yeah, if I do that, it's going to want to show me all the drawings again. Let me move this to another board. Hold on one second. Okay, so I want to show you this. I made a line that's the same size as this red candle right here. And you know, what stands out to me is you don't get these red candles normally in an uptrend. They're not normal. They either come during downtrends or right after an uptrend is over. Well, which is technically the beginning of the downtrend. We'll move back in time. So you can see you know, a little one that's larger right there, a larger candle there, big one there. Here's an uptrend. You can see there's not a single red candle anywhere close to this. Here's a big downtrend. That was that huge drop back in 2018, the fourth quarter. There's a red candle that matches. There's one almost as big. So you get the point. Here's the big drop back in early 2018. We had a sharp correction in the market, 2 legs down, and you can see that. So again, I can go back in time, and during healthy or just during uptrends period, you don't get these candles. You just don't see them. And then we can go back the entire bull market, and you're not going to see. Now I dragged it and messed that candle up. You're not going to see a candle this size on the weekly. So it has bearish implications. What it means is a lot of traders were wiped out. And again, that we see that on the daily chart. We know, we could just go back to the daily chart, even from where we closed today, right here at 304.38 or so, we have wiped out. I'm going to just go to the left here, all the way back here to Wednesday, May 27th. That is 16 days. We wiped out the past over 2 weeks of gains. So you know, everyone that bought all over here is now underwater, and there were a lot of buyers, I think, chasing the rally. You get the fear missing out. So there's some bearish implications to be taken away there. And again, I'm not waffling. I'm giving you both sides of it and just telling you that, you know, yes, check marks for the bearish case, but also we're in an uptrend right now. We have been from the lows, and again, we're above those key support levels. We'll look at the sectors in a second. So that's what it looks like on SPY. A couple others to look at. Let me get rid of that line there. The Dow, let's see what DIA looks like. The Dow had a primary bull market uptrend line right here. This trend line comes off the lows in 2009. Last week, it had taken out that trend line, and then so far this week it failed. So this week is over, and we close back down below it. So that, as of now, puts it as a whipsaw. It's pretty much a back test. It regained it again on a weekly closing basis, but fell back below. So the further we walk down now, that would indicate, you know, that that was just a little whipsaw signal. A lot of momentum carried it up through there. The other things to note on the weeklies, you know, these PPOs are still solidly in bear market territory. When you have the PPO line, especially that white line, I like to use a signal line down below the zero line, the trend is bearish, and in a bullish trend, they trade above there. So that's something to note. We're buried even back in 2018, as ugly as that drop was, or you know, pretty if you were short. There was you know, we went down, and we didn't go down that far. We're buried down. This is bear market, you know, type. We don't see, here's the last bear market. That's the last time you've seen the PPO buried down so deep. It is still in, you know, bearish territory. Wanted to point that out there for you. And then, of course, like I said, the Dow not recovering that, or losing that trend line again. QQQ, you know, QQQ can't really knock it too much, but you have on the weekly chart, remember, big divergence, negative divergence that has been put in at this recent high. Qs have been the strongest index up until, well, they have been the strongest index even on this move up of the big major, but again, it's not really as diversified as Dow and S&P 500. Even though you have 100 stocks, it's just mostly tech stocks carrying it. So that rolls me into the next thing. I want to just look at the sectors and key stocks. That's the post I got out about 5 minutes before the close. Just an FYI to that, if you didn't get this, you know, within, you know, a few minutes before the close, then if you're using a mail client such as Outlook, a desktop-based mail client like Outlook or Thunderbird, or even your phone, you know, you need to go into your configurations and have it check for emails at least every minute. So a lot of times the default setting, it'll check every 5 minutes, 10, 15 minutes, or when you open up the your mail folder. So these emails go out. I use a third-party service, called MailChimp, and they fire that off. It's the only way to do bulk emails. If they came out directly from right side of the chart, they'd get flagged as spam. So MailChimp, pay them to do that, and they do send those out instantaneously. You should have it within a minute of it being published, and this one was sent out at 3:55. I would have got it out earlier, but I was watching the price action, looking at everything, and then towards the end of the day, I started taking a look at the big FANG stocks and the sectors, and that's what prompted me to start working on putting these charts together. So we'll run through them real quick. Amazon, again, these are just the top 3 largest holdings in the broad market in the NASDAQ 100. Amazon, as I mentioned yesterday, no change really. In yesterday's updates, I said we're above both a key price support, 2470. Here, if you can't make that out, let me zoom in. Remember, all these charts on the home page on the site, you can pan and zoom, move them around, scroll. You can use this if you don't have a scroll wheel on your mouse or touchpad. But that's the big level, 2470, give or take. I see nice support there that was resistance, and we have a clean trend line here. So you had a divergent high, you had a little doji stick, 2 red candles, looks like a top to me. There are still big, powerful divergences, negative divergence on Amazon. So I think that ultimately we go down below there, but until then, like I like to say, support is support until less broken. And when you have almost all the market-leading stocks and the market-leading sectors above support, in fact, although we had those big sell signals on the market itself that I talked about, we didn't have really any solid or strong sell signals on any of these FANG stocks. So that's, again, one of the things giving me pause, as I said yesterday as well. We had big down days on them, but it didn't break trend. It didn't break support on Apple here, about 327. That's the previous reaction highs. That was a big level. So this was our breakout to new all-time highs on Apple, and it's still very much intact unless we drop below, significantly below 327. To get there, you're going to have to first take out this trend line. So those are the things I'll be watching for in the coming weeks. Microsoft, same thing. The trend line here is drawn, with that magenta color, whatever that is. I'll show you right here. That's uptrend line, and as I covered yesterday, pretty nice support about 186, and there's Microsoft still above it. So these are the things that I need to see go. You see all these 3 stocks that I just covered smash through those levels, solid closes. That will be a pretty powerful sell signal if and when we get that. It could come soon. It could come 2-3 weeks from now, a month from now, or who knows? Sooner or later you'll get sell signals. They just won't be these. If we continue higher, new trend lines may form. New support levels to watch. But as of now, that's what I'm watching. So, all right, that's those 3 big ones, and then the sectors. We'll just go through those real quick. XLK. Here, I can pull up the live charts. Let's just do that. XLK. Back to the daily chart here, and put on the lines. There it is. Remember, we had this big gap. That's that gap that the SPY had failed at. The big gap that started this whole thing off. That one, the tech sector took out, because tech has been stronger than the broad market. Financials and industrials and other sectors have been holding the market down, while technology has benefited because they're pretty much, for lack of a better term or word, COVID resistant, or not nearly as impacted by COVID as a lot of the those other companies were in the different sectors and industries. So it did break. I did want to say that we had a sell signal on XLK. Unlike a lot of the FANGs, are pretty powerful when we took out both those trend lines, a trend line off the lows right here back in March. But we have some pretty decent price support right there. So that's the story. We pretty much need to drop about another 2-3% in the broad market and the FANG stocks and all that to really help solidify these recent breakdowns. So one possibility, it's not an all or none thing. We can bounce next week, but then come in and there's a lot of overhead nearby resistance levels, such as the gaps I mentioned on the index, such as these trend lines on XLK. These are things to watch and maybe provide objective short entries, but to me it's not an all-in short market until the FANGs break down, until most of these sectors break down. So there's XLK, a sell signal, but still some decent support. The other one, that's the largest in the S&P 500. Second largest should be XLV, healthcare sector. XLV had divergence, negative divergence leading up to this high right here, and it's kind of been grinding around. When you go back a little bit in time here, which I'll do right here, we have these ranges. The healthcare stocks back before the top, they were grinding around sideways and then finally broke down with the rest of the market. And they've been doing, for the most part, the same thing, but in a little bit larger, wider range, because volatility has been, higher than it was back there after this whole thing started. Long end of it, they failed at the previous high so far. You had a rejection to break out the new all-time highs, fell back to the bottom of the trading range. Big red candle yesterday, but the thing is that bottom of the trading range is support. It's about 96.70 or so. And it's not only that price support, all these candles right here that we've had for the past few months, it's early April, but you also have, you can see the red and blue lines, the 200-day simple and exponential moving averages. They're coming in right now, right up to where prices are. So again, this is why I'm doing this. This is why I talk about all this stuff. Some big levels that if we can just get a solid move down, a drop 2-3%, the farther we can put those in the rearview mirror, the more it helps. But remember, XLV is only one of 11 sectors in the S&P 500. You're going to need to see breakdowns in tech, additional breakdowns, as well as the financials. Here's XLF. What stands out to me, I know there's a lot of colors on this chart, but what stands out to me is XLF there was a big old gap right here, and that level, and that's why I had a purple line, it was pretty important. It was resistance. Tried to break it, failed, resistance, finally got it, and then they started to run. Now we've pulled back to that level. We dipped below it yesterday, closed a little bit below it, but we regained it today. And again, there was a lot of momentum heading down. Financials were getting hit hard yesterday. So as of the week, we closed back above that former resistance, now support level. So the financials need to, like everything else, just a little more downside, and that should open the door to more selling. Otherwise, they certainly have the potential to, pick up where they left off and rally next week. Just two or three more. XLC, communication sector. This is an ETF, but it's really just two stocks, Alphabet and Facebook. They make up almost all the performance of this one. So those are the two big fangs that are not in the tech sector ETF. They used to be considered tech companies, but they got categorized into the new communication sector a couple years ago when they got rid of the old, for many, many years, XLT, I think it was. XTL maybe, there was a telecom ETF that tracked the telecom sector, and telecom is yesteryear. That's Ma Bell, AT&T, all that stuff. So what they did is the S&P, Standard & Poor's revamped the S&P 500 and changed the telecom sector to the communications services sector. And in that, you have Alphabet, Facebook, you have Verizon, AT&T are in there, but you also have Disney, Netflix, a lot of companies that stream media content, things like that, or just make money that way. It's an important sector. There's a pretty good weighting. It's about over 10, almost 11% of the S&P 500, and we had a solid sell signal. That trend line was a clean trend line break gap, but it's flirting with this support and closed back above at that 54.31 support level I had. So again, need a little more downside. I think obviously a break below today's lows should do the trick on most of those. There's minor support there. Let me put a line there. So yeah, we need to take out today's lows with conviction on that one next week to really open the door to more selling. XLY, same story. These are all levels I've had for a while on these charts. 120, 244. This is consumer discretionary. Solid breakdown, solid sell signals, but yet we hit support and we held it. So, and remember, even if these sell signals play out in the long term, when you break a downtrend line, sometimes you never look back. You break it and then you keep going. You're going to have zigs and zags along the way, and sometimes you come in and you back test the trend line at a higher level and then roll over. So now a back test is something you probably wouldn't want to ride out short. Just say for XLY, for example, if you were to back test and let's say it took about to this point to get there, Well, that would be, that's only a couple days, but it's about 9%. See, that trend line is steep. The steeper the trend line, the more it takes to get back to that trend line when you have a back test, because trend lines are dynamic. That means their value comes in at a different price every day, in this case on an uptrend line, higher and higher levels. So again, not something you'd want to ride out short. And if it did that, if it went in for the back test, and guess what it's going to do? It also, XLY had an island cluster top, and it's going to take that out and negate that whole, that particular sell signal. Okay, last one, industrials. I'll just point out they broke down like some other sectors and indexes. They broke down on Wednesday, followed through yesterday. Not really solid support, so I'm not going to spend any more time on it. We're going to wrap up, just look at the futures for those of you that trade futures, or even want to just track futures to see where the market's going. Another thing that gave me pause before the close today are these divergences and the fact that these targets were hit. These were, from at least last few days, maybe a week or more, I've had these potential targets and support levels. The next one we hit that 95.27 today. I took it out, and we had I had 94.84 right there, and that's pretty much what we hit and reversed. And when we did it, remember earlier today we had these breakdowns of these trend lines. And that was the either an objective. If you didn't short the bounce into resistance, you could have shorted or reshorted the breakdown of the trend line or stopped out of your longs. Then once that happened, that's where we fell. Now when we did that, we put in, as you can see down here, divergence. Pretty strong divergence too. This is positive divergence. These indicators, RSI and PPO, making much higher highs with prices making lower lows. So you have on the 60-minute chart of the futures, you have the stock futures falling to support with bullish divergences in place, and that's how we ended the week. Let's look at ES. A similar story. Pretty steep divergences right there with the indicators. And also ES hitting that next target I had here down there of 29.7765, rounded off to whatever nearest number, but there it is, positive divergence right there. So again, these are little micro levels. There was a question on the home page today. Somebody asked, well, aren't the levels on the same on 60-minute charts and daily charts? And no, and somebody else, a member, Becky, had answered, and thank you, Becky, for doing that. You have more candles over a certain period. In one day, you have multiple candles on an hourly chart, and even a lot more on a 5-minute chart. And that will help you identify support and resistance levels that you may not pick up or may not be noticeable on a daily time frame. And in trading, that it's commensurate. The time periods for these trades. If I take a breakout of a bullish chart pattern on a 5-minute chart, I'm probably day trading. I'm looking for a move that might only last a couple hours. If I take a breakdown on a 60-minute chart, it's probably a move. It depends on the whole scope of the pattern. Like in this case, this was a longer-term trend line that led to a much larger drop. But then you get these little minor trend lines, and they give you these smaller moves. So everything is proportionate to, number one, the time frame you're on, and then within that time frame, the scope or magnitude of the patterns. Little wedges, little trend lines usually equate to a small move. And if you have the bigger the pattern here, you were trading sideways for a while, you broke out, and that was a powerful pattern. You back tested it, and then you went on. All right, so this is where we ended the day. So while we had a bearish event earlier in the day, we had a rally back to resistance and a failure there, bearish event number one, then a breakdown, but then we fell to support, and that was bearish. It was a pretty impulsive drop, but then we hit support with bullish divergence, and so far that's NQES, and then to wrap it up for you small cap traders, RTY. So we have a trio of those pretty much all the major indexes. You'll probably see the same thing on the mid caps. If I were to pull that up in the Dow, you're going to see they're very similar, bullish divergences. And RTY, the small cap ETF, hit that, and that was a pretty big level right there, a pretty big support level, 1355.66. So that's where we ended the week. Now here's not the hard part, but this is how my mindset goes into technical analysis. The longer the time frame, the more significant the developments. In other words, if I were to get a sell signal on the daily chart, which we had the other day, those yesterday's sell signals, those sell signals, for the most bullish developments or bullish events on the short-term charts. It kind of goes back to what I was saying, but now this will play out, and so far it did. These divergences did play out, and they could play out for a little bit more. In fact, they could play out for quite a bit more. And this is just near-term stuff. So this is what we could see Sunday night when futures open, or Monday, something like this. But as long as it doesn't take out those levels that I talked about on the daily chart, this could be, near term. It certainly is a setup for a near term bullish setup. But as long as we remain below levels that we need to, that I covered early on the daily chart, it doesn't change that longer term or intermediate term outlook. So this 60-minute chart, this is short term stuff here. And now, with all that being said, divergences, buy signals, and all that don't always play out. So to see this fail to materialize for a nice rally next week, to see the futures open up on Sunday night and just dump into Monday morning like this, and head down to my next target here at night, about 1300, well, that would be pretty darn bearish. It would mean that this bullish setup here failed to materialize, so there's not a lot of buyers in the market right now. There's more sellers. And if it does happen, like I said, that's the next support. And how do things look if and when we get there to 1300? Would we have these divergences still in place? If so, then that might set the stage for an even better rally. Sometimes you have these divergences bullish, just like the bearish divergences. They might not play out, or they play out for just a little move, but then you continue the trend lower and they set up, and finally the larger divergences play out for a larger rally. So those are things I'll look for next week. And again, you can see the resistance levels overhead and the nearby targets, and I guess that's it. So like I said, kind of a mixed bag of technicals. Market has some work to do on the downside to help solidify those recent sell signals and open the door for a much larger swing trade to the downside. I'm leaning that way now, but I can't tell you with the highest degree of confidence, because those market leading stocks in particular have not broken down yet. And then those stocks and sectors that have broken down, many are at pretty decent support levels where the buyers still may step in next week. And if they don't, and the market continues much lower, then that tells us the buyers have dried up. That Last Long has bought his or her share, and now there's more sellers and lurking and stepping in, and it changes the whole supply dynamic of the market. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.